Good morning. It is 11:01, and I'm in France, so you can probably hear the cicadas in the background. That's not too disturbing. Relatively quick from me this week. There's just a couple of news things I want to talk about: personal assets and Adamas finance. And then I'm going to be bringing in Nick Wood, who is the head of investment funds at Quilter Cheviot. We just thought it would be interesting to hear from somebody whose job it is all day, every day to pick funds, to see what they think about the current state of the markets and what sort of things they're buying at the moment. And Nick's got a lot of experience in the sector as we come on and talk about. But me first, so personal assets. I wanted to mention just because it's a sort of momentous time for it at the moment, as we'll come on to. They've just published their results this morning for the year to the end of April. It sits in the flexible investment sector, and you can see on this slide, which is probably barely readable, there's an awful lot of constituent parts to it. If I just strip out the extraneous different costs of share capital, you can see it's still quite a long list. To compare it with more relevant things, I've just reduced it slightly. They're not all strictly comparable. So Avenue Diversified and Seneca Global have obviously got a yield target, and that skews what they invest in. RIT is a family office type thing. Caledonia is saying Caledonia's probably least like any of these. So maybe the closest competitors to personal assets are Carthew, Gearing and Ruffer. And as you can see, personal assets is decent size, trading close to asset value because it's got a discount control mechanism, which means that it buys and sells shares around asset value. Not much for yield, that's not the point of the fund at all, and relatively lower ongoing charges. Excuse me. I do not have COVID, in case you're wondering. So in terms of the recent performance, which we wouldn't normally dwell on, but obviously with what's been going on, it's quite relevant. It has been churning out positive returns, and that's obviously a good thing. So in this little subsector of the peer group, it's second best performer over 6 months, behind Ruffer, and I think that's not a bad outcome. And obviously, because of the discount control, the share price has been keeping pace with that. On a longer term basis, these numbers are out to 10 years. You can see that its returns are to middle of the pack, maybe. And that reflects the caution, really, that they've been adopting for a very long time now. So they've been trying not to take too much exposure to markets that they think are particularly vulnerable to a shock of the kind we've just seen. In its results statement this morning, these are the numbers that they've put up since inception. Well, it actually technically goes back to 83. They rejigged the funds in 1990. So those are the sort of relative numbers. Normally we don't talk about the FTSE All Share, but I've cut it and pasted it from them. And you can see that its returns are way ahead of the UK market and of inflation. And that's really a big chunk of what they're trying to do. And they've also been issuing shares. Protection type strategies, absolute return strategies have been in big demand over the last few years. And so £142 million worth of shares issued. If for whatever reason that went out of favour, they would buy them back again without any hesitation. Low volatility is a key part of what they're up to. The actual objective is to protect and increase, and they always state in that order, the value of shareholders' funds. But as you can see from this chart, which actually is the one for the annual report last year, the new annual report's not quite out yet. It will be probably later today or tomorrow, but it won't have changed much. It is the lowest volatile of any of this peer group that we've just been looking at, and the global funds that it used to sit in the same peer group with before the AIC created the flexible investment sector. It's done that by not having too much in equities. So this is the position at the end of April. And you can see there's a big chunk in gold, and I think that includes gold mining. I said so it says gold bullion, so maybe I don't. And then UK T-bills, so short, almost like cash, and US Treasury inflation protected securities. So they're basically like UK index linked gilts, but the US ones. Almost a third of the portfolio, because they are nervous about inflation, although not in the immediate term, as we will see. That equities number, 44%, is relatively high. And what it reflects is, if I put this chart up, they were quite quick off the mark, and I think this is to their credit, to shift the asset allocation around when the markets fell out of bed. So they were in there picking up some bargains. They got rid of their US Treasuries and the UK index-linked stakes, ran down their cash and sold some of the UK T-bills and put that money into equities. And I think that's to be commended, really. So this is really why I wanted to talk about it. So the two guys in the middle, Robin Angus and Hamish Buchan, are stepping down from the board at this year's AGM. And really, these four guys here have been really responsible for the whole of personal assets since it revamped in 1990. Ian Rushbrook, I used to know quite well. He was brought in as the investment director in 1990 and ran it with the conservative style. Robin was already on the board. Hamish was, I think, broker to the fund and then joined the board in 2001. So he's been involved for a long time. I knew them because I'm pretty sure, and this is one of these false memory things, so I can't find anything to prove it, but I'm pretty sure I held it in the M&G Fund Investment Trust, so going back to mid-90s now. But I've been following it really from even before it revamped in 1990, I think. And then it was a shareholder in the fund that I used to run, Advanced UK, in the sort of early 2000s. For that reason, I didn't buy any shares PA, just too much of a magic circle thing. But I have been a shareholder in personal assets since 2011, so after I stepped down just before we started QuotedData. And really, it's because of this long-term, low volatile, protect your money type thing. But the other thing I bought around the same time was an open-ended fund called Trojan. It's one of the few open-ended funds I actually hold, run by Sebastian Lyon from Tri Asset Management. And when Ian sadly died in the end of 2008, they brought Sebastian in as the new investment advisor. And he's been in that role then for the last decade and more, running the fund in a very similar style to the way that Ian did, under sort of guidance of Robin and Hamish. And the changes that we're going to see now, so as I said, Robin Angus coming off the board, Robin Angus and Hamish coming off the board. And Sebastian's been made the investment manager formally as of, I think, just now. So it's all changed, but I think business as usual, which is probably encouraging. Ian, this is a long quote, so I'll talk while you read it. Ian was quite nervous of exuberant markets and called the credit crunch completely correctly. So this is from their AGM in 2007. And he was very critical of what was going on. I mean, one of the things that we get from our other managers that have this sort of views, that the credit crisis isn't really over yet. Everything that we've seen in the last decade is just a continuation of the problem that was being created in the run-up to the credit crunch. And what's the policy response to COVID is kind of exacerbated the problem. What Sebastian thinks is that we're now in an era where value is going to be a very tricky way to make money, which is obviously bad news if you've been holding out for a snapback of the sort of value versus growth charts. Value's been underperforming for a very long time. And one of these things that we've talked about before, especially around the advent of new technology, is that many companies that would have reverted to the mean in terms of valuation are now finding that their business is being cut from under them by new entrants and new technology. So the number of value traps is potentially increasing. And within that, we may now have whole sides of the property sector as well, which is something we're going to have to tackle. We're obviously talking about that in our property conference I'll mention later. And the other thing is he's a bit wary of current markets, and I think I am too. It just feels like there's too much hope in there, which is always a bit sad to say that. But it's going to take a long time to sort all of this out, and I do worry that a lot of the oil markets is just underpinned by all the money that's sloshing around, that's been injected into the financial system, to try and sort of stave off any disaster. Which might not be great for the future. So I think still going to stick with my Postmasters and my Trojan holding, although I might maybe switch the Trojan into Postmasters at some point. Obviously, I can't see much of a discount opportunity, which I'd normally like to do, but never mind. I do think it's one of the best ways of protecting your money for the long term. So, positive note, and then we're going to a tale of woe again. Adamas Finance Asia, which we've written about a couple of times over the last year or so. It really wasn't much on the radar. It's a relatively small fund, but it's got a new team and they're trying to revamp it, trying to really provide finance to small Asian companies that need it. Potentially interesting idea, all great. We were kind of interested in what they were up to. On a huge discount though. But when we had a chat to the manager, it became apparent that they were considering issuing stock at a discount. And we warned them quite sternly that this wasn't a good idea. But they went ahead and did that anyway. You can see the returns have really not been great. I think it's going to end up rivaling Trade UK Public Private for the worst performing fund in this sector in NAV terms. What they've announced this morning is they're going to do an open offer placing on a kind of 1-for-8 basis to raise 3 million quid. And with each of those shares, you're going to get a warrant, which is exercisable at 40p. So NAV is about 65p. These new shares are being issued at 25p. You can see the potential dilution there already. Plus the warrants will be dilutive as well because they're exercisable below NAV as well. 25p, as I said, there's a 13.8 discount to last closing price and a 60% discount to the NAV. I reckon the combined effect of this takes about 10% off the NAV for existing shareholders. It's really not great news. And the trouble is that this sort of thing, once you've done it once, it's addictive. They've already done it in October 2019, and you can see that they were issuing shares at a massive discount, but at a higher price. So it just becomes this never-ending thing of like, we've got great things to invest in, we desperately need the money, and here we are doing an issue, and we can get new investors because they're going to give them some of the existing value in the stock as a sweetener to get the deal done, which I really object to quite strongly. Keep an eye out for it though, it's going to change its name. Jade Road will be the new name, so avoid that, I think, in the future. So on that happy note, let's talk to Nick, who's probably invested in some much more sane and sensible funds. So Nick, can you unmute yourself and say hello?
Yeah, hi James. How are you? Thanks for having me on today.
Yeah, that's why it's a good idea, I think, just to get people to hear what's going on at the coalface, if you like. So I think, can you just sort of say, I mean, I've got a sort of brief bio of you here. So how did you end up with this job at Quilter Cheviot?
Yes, well, sort of a circuitous route, really. So I spent 10 years at a company called Capital Group, big US asset manager. At one point, I think they were the biggest asset manager in the world. They ran sort of manager of manager portfolios internally, still do. And from there, sort of just analysing managers internally, it kind of nicely led to a move across to a place called Stanford Associates, who look at external managers, and you might have heard from of them. They run the St James's Place platform, among others. And so that was my second position, and then from there I moved to Quilter Cheviot, and in time took over as head of the fund research team there. So I've been here about coming up to 8 years now, and that's a very enjoyable time it's been too. But our team, maybe just to give you a little bit of background on what we do. So I head up the fund research team. Quilter Cheviot is one of the UK's larger wealth managers. We're looking after about, well, end of March it was about 21 billion. It'll be a little bit more now. And I have a team of 10 sort of dedicated fund research analysts alongside me. So big team. We only research funds and trusts. We don't specifically manage money. You know, so there's a mix in terms of, you know, those investment managers, you know, those that favour investment trusts, those that quite like open-ended funds, might well make use of both of those. So there's, you know, there's advantages and disadvantages of both, and you know, as you all know. You know, our job is really to highlight our key convictions, and ultimately, you know, I spend my time meeting with.
Oh, have we lost you? We just have to pause for a bit, wait for Nick to come back. While we wait for Nick to return, one of our attendees asked a question about personal assets, which I'll just answer, which is actually, about the share price. The share price, as you saw on the chart earlier on, is enormous. So you can only buy a few shares at a time. That reflects obviously the capital growth that they've achieved since they launched. I've talked to them about subdividing them. Other people have as well. I think it's a good idea. A lot of their shareholders actually disagree. They think it's a sort of sign of success, a bit sort of like Buffett style. So they want to keep the whole thing going. The beauty of it would be if they split the shares, that it would be much easier to buy smaller chunks to save money into them on a regular basis, and that would be the attraction. So that would be my preference, I think, for what they should do. There we go. Is Robert Angerson involved at all? Yes, he is. Well, he was. He was the director until this forthcoming AGM. So yes, he's going to retire in a second. I'm trying to bring Nick back, and it's not letting me. It's quite frustrating.
Hi, James.
There we go, back again. Right.
I'm so sorry. Do you know, this hasn't happened the whole of lockdown, as typical as today. really sorry about that.
No, don't worry at all. Don't worry at all. I was worried it was me for a start off, so I was thinking like.
No, it was me. Yeah. Well, sorry. Where did I get to? I suddenly.
Well, actually, I was about to ask you a question. So, when you've compiled this list, is it mandatory? Is this the only thing that people are allowed to buy?
No. I mean, so you know, the list is pretty broad. You know, I think there are. Well, in terms of investment trusts, I think there's about 75 on there. You know, nobody's buying all of those, but you know, for investment managers, you know, most of what they buy will be off the buy list, but then there's a portion where they might sort of step outside of that, and you know, but there might be particular reasons that it suits the client to invest in something else. Perhaps it's a smaller investment trust. Perhaps it's something that's you know, something more particular to the client needs.
Right. Okay. So we often hear that the big wealth manager firms won't buy small funds. Do you knock things out on the grounds of their market cap?
I think that's a fair comment, actually, and so you know, if I was going to give a ballpark number, you know, I think really 200 million is probably where you're looking at. So that's for a centrally researched holding, and if you think about it, you know, with the amount that we run, it's, you know, you want to give everybody the opportunity potentially to buy into it, and of course you've got to think about liquidity. You know, when things hopefully things always work out well, but you know, liquidity, particularly in more difficult times, when you own a lot, is, you know, can be tricky. So we are looking at the larger market cap. You know, our individual investment managers can sort of, as I say, you know, have the license to invest, you know, where they wish. But it is a consideration. I don't think it's especially, you know, I don't think that especially impacts our abilities. And if you think about it, I mean, you know, often we always see, you know, new raises potentially, and you know, that's a consideration. You know, how big is this going to be? It's always a sort of open question. But you know, what we sometimes find is, you know, the more successful ones will just naturally grow, and maybe we don't invest on day one, but you know, the subsequent raises, you know, that can be a good time to do so. So it's, you know, there are some, of course, there are some interesting niche things that we that maybe you might like to go to look at and we just avoid, but it doesn't feel particularly limiting.
Yeah, and I'm notorious for looking at little niche things. It's not always a good idea.
Yeah, no, I mean, they're great, you know, it's only great when they work.
Yeah, cool. And what's the experience been of the past sort of 6 months? Were there sort of panicking clients and money running for the exit, or are people quite sort of sanguine and let you get on with it?
Yeah, I think, so, you know, I tend to speak to a few less clients than my sort of investment manager colleagues. I know there's been lots of calls. You know, I think we've been fortunate that we've been sort of, dare I say, on the right side of the trade, at least from a relative point of view. You know, we have a bit more of a quality growth bias, and you know, for many of our clients, of course, March was certainly a painful and difficult period for, you know, in all sorts of ways. So yeah, some sort of there was certainly some concerned calls, but I think, you know, I mean, it's interesting how rapidly the market snapped back, as you'll know. You know, it's both one of the fastest declines and also one of the fastest recoveries. So it hasn't been an extended sort of drop, and I think that's probably been helpful in terms of having those client conversations.
So what?
I think.
Sorry.
Sorry, I was just going to say. I mean, on the other side of the fence, you know, so I mean, in March and April, you know, our team ended, we had about 200 plus meetings with fund managers, and I think the interesting thing I found, certainly from say some of the equity managers, you know, trust and open-ended, not many of them were, you know, what were they doing actually? Were they panicking? Really, not many of them doing very much at all. There was the odd one that was quite active, but I mean, I found it quite interesting that most of those the equity managers were pretty much sat on their hands. You know, there were some obvious things to exit that were just, you know, this is really not the environment to hold this, but and maybe I'll buy something a little bit cheaper or higher quality. But you know, most of them didn't really do very much. So I found that quite interesting. You know, that from my perspective.
Cool. Okay. So what sort of things do you love at the moment? Are you steering people towards defensive investments, or is it like still looking at broad spread of things?
Yeah. So you know, we all, I mean, within our universe, we always have a sort of a broad universe in terms of the kind of things available. And but I think again, back to, you know, what our sort of house view is at the moment. It's been to invest in sort of quality growth companies, and that really hasn't changed. I mean, you know, you touched upon it earlier, and in that quote, you know, some of the long-term trends, some of the reasons we like that area have just been accelerated. So if I'm, you know, if I think about some of the areas in the investment trust space, of course, Scottish mortgage, you know, everyone's favourite at the moment. We have a meaningful investment on that and a positive view. Another one, slightly, you know, same house, but fairly different US growth is a slightly less well-known trust. It's managed by you know, pretty much the same team, different lead PM. They launched in 2018. Actually, slightly under the radar. You know, that's actually done slightly better than Scottish mortgage in the first 6 months. So that trust was up 50% year to date. So you know, not all of our clients will have investments in that area, but there's a good example. They're buying into growth investments. Their top 3 holdings are I think Shopify, Amazon, and Tesla. And that's been a really phenomenal investment. I mean, the key concern there is both the you know, with all these kind of things, the valuation of the underlying and valuation of the trust, and that has moved up, you know, over time. I think the other, you know, maybe some other sort of thematic investments within sort of that broad area, you know, healthcare and technology broadly. That so something like Worldwide Healthcare and Polar Cap Technology. Again, you know, very well known trust, but they've you know, they've certainly sort of done what we expected them to do. And then maybe one other area I just mention is absolute return, the absolute return area. You know, you touched upon one sort of subset of that earlier, but and we, you know, we hold a decent amount of RIT. Another one would be BH Global. That's sort of fund hedge funds run by Brevin Howard. It's, you know, again, you're always looking at where the discount or recently, you know, reasonable premium is. But you know, I found it quite interesting. Its absolute return has been a tricky space in recent years. But what we've seen this year, particularly, is that, you know, when in the period of crisis in March, some of these, both open-ended and in this case, you know, BH Global, actually did very well. They handled that well. BH Global, specifically in March, the NAV was up 12%. So, you know, clearly that's very good. The prior 2 years, you know, it was, you know, they produced a 5% return each year, so you might be a little disappointed with that. But I think in terms of thinking about diversification, you know, some of those kind of vehicles, I think maybe they've had a bit of a bad reputation, and they're worth, you know, I think they're worth at least considering in a sort of a broader portfolio context.
Okay, cool. We have a question for you here already. So if anybody wants to ask a question, just stick it in the Q&A or send me an email at jc@marketingco.com. So what's your view on gold? and funds that hold it and those that don't?
Yeah, so we've got a positive view on gold. Within client portfolios, that would generally be via an ETF. It's not suitable for all of our clients, but that's I think that has been that's been a positive driver for our client portfolios. There are some trust vehicles that has some exposure. I forget whether personal assets does specifically that we talked about earlier, but there's certainly some others. But actually, in this particular case, I think going down the route of some of the ETFs will be the way that we have we sort of gain investments. And in a low yield environment, that's generally a more positive environment for gold. And there's not much that's really that diversified at the moment, and it's provides that diversification. So I mean that's certainly one area.
Okay, cool. Would you go as far as buying something like well, so golden prospects too small for you, but Darrell mining maybe, or one of the funds?
It's been interesting looking at it was interesting looking at what happened with the gold miners around about March, because there was a huge disconnect actually. You saw gold price going up significantly, but actually at least in the short term, actually some of the miners didn't fare particularly well. There was a reasonable sell-off there. But yeah, I mean, but potentially you would. I would just say I think there's a bit of a different a bit of a different profile for gold equities versus the pure physical.
Oh, okay. VH macro is a bit marmite, says this person here. What do you like about it?
Yeah, so there's two that are VH run. We've got some investment within VH Global, and I think the depth of resource at I mean hedge funds as a whole. Let's not shy away from it. It is absolutely a marmite topic. In this case, I think you've got a very experienced team. I think you've got the environment is more conducive, I think, to their traders in terms of their ability to generate alpha. And in our view, this is something that for those clients that own it or own other sorts of investments which you might say are a little bit uncorrelated. It's there as protection. You saw in that March decline that a lot of these sort of more, we'll call it more sophisticated vehicles, if I can call it that. They're very quick to take risk off the table, and I think it just provided you some additional sort of downside protection and diversification. Our clients might own a lot of equities, and this is something which just provides a bit of protection within that space. So it doesn't always it can the whole area can be at times a little bit disappointing, and they can be expensive. But I think this year has shown that they have a purpose potentially if you're that way minded. And you touched upon your views on markets today, and it's maybe we're not going to see another downturn, but I think we're certainly it continues to be in a less certain environment today.
Yeah, cool. Okay. Do you have a view on trusts that return capital to regular target dividends, even if they're not generating sufficient income? So I suppose there is not just
the first bit of that.
So we're not talking about funds that are just topping up their income from reserves generally, but the ones that pay out a yield and some capital rather than generating it from income.
We've tended to prefer that they, income is properly generated from underlying holdings, but I don't think I've got a especially strong view on that. I mean, it's I think taking the natural yield, sort of feels to me like it makes more sense. But as I say, I'm not particularly objecting to that. And I guess particularly today, where we have clients who are income hungry and from a purely a lifestyle perspective, they need that income. I guess that's sort of no bad thing in these funds.
Cool. Okay. Do you see a kind of new blue chips in the FANGs, basically? Do you think they're the kind of blue chips of the future?
Yeah. Well, it's the FANGs. It's the many other companies which sort of are coming up behind them. There's a huge amount of innovation at the moment. It's fascinating speaking to the guys at Polar Capital, for example, or plenty of small cap. I was chatting to a small cap growth manager the other day, from a blended fund, but they've been running money for 30, 40 years, very experienced, and it's just saying how really at the moment it is just so ripe for innovation. So clearly valuation is the key here. We've had a very strong run for growth for basically 10 years, but with a long-term view, yeah, I think this still kind of makes sense. On the flip side, it's interesting. Again, we touched upon value earlier. Things we're looking at the moment. There, you look at something like Fidelity Special Values in the UK. Alex Wright. There's a manager. The trust is on a decent discount. He's a manager that I think when you assess him, he's clearly a value manager. He's looking for sort of catalyst for change. He's managed to perform pretty well actually, despite the headwinds, and that might be some an investment that you might want to pair alongside sort of more some of the more out and out growth investments. Personally, I think not putting everything on the sort of the growth pool, should we call it, makes sense. We had a bit of excitement a few weeks ago, a couple of weeks of value being a little bit more in the sun. Didn't last very long at all, and but having a balance there. There are some interesting sort of more value orientated funds. As I say, Fidelity is one that I think is interesting enough, at least in the UK.
Yeah, it's actually sort of what Sebastian Ryan was saying. I think value is not dead, but the difficulty is it's just harder to avoid value traps maybe than it used to be.
No, absolutely. And Alex Wright, quite, he does. I would say his process at least is a little bit more sort of catalyst orientated as well. So different types of flavors of sort of value. And actually, it's interesting in the US in particular, more broadly. You see lots of value managers finding, whatever their process is, they might find a reason to buy Microsoft in particular. Everybody owns Microsoft at the moment, Steve. But equally Facebook, Amazon. You look hard enough and long enough out, and they might find some reasons to buy. And it depends on my job really is to look at some of those managers and work out, well, actually, does that fit your process, or actually are you just trying to sort of, is this career risk mitigation, and are you sticking to your knitting here?
Yeah, sure. Okay. Would you buy an investment trust that invests in large cap developed markets, or do you think ETFs and open-ended funds? Well, it says ETFs here work better. Yeah.
It clearly depends on the particular situation. But if I think of a couple that we quite like that have invested in large cap, so we've got something. So in the UK, we've got something like Finsbury Growth Income, Nick Train. Clearly that's done extremely well, and I think I would happily trust him with my investment. He also invests a little bit down the cap as well, but that's fine with me. In the US, the US is the classic area here, right? You can never can never outperform if you're investing in the US market. Well, Bailey Gifford has slightly proven that wrong, star in their favour. But another one would be that I quite like personally is JP Morgan American. They've had quite a lot of change there at the moment. That's two very experienced managers, both running sort of 20 stock portfolios, one value, one growth. Kind of looking at sort of, these need to be higher quality companies. So we're not talking about really sort of beating up businesses. But they took over about a year ago. Actually, it's been a little bit of a weak start so far. But both of those managers have got excellent track records, good long-term investments, and you do have the benefits long-term of the investment structure in terms of it might be the leverage in a rising market. In the case of JP Morgan American, it's quite a cheap investment actually. The OCF is pretty low there. Not as cheap as passive, but I think that's a perfectly reasonable investment. And if they can add value long term, I think that makes sense. We wouldn't shy away from in the US holding a passive though for sure. But it's about sort of mixing those two together. Other area I was doing some work on UK small cap the other day, and there's an area that it's you mentioned large cap, but there's an area where it's just incredible how well the UK small cap managers have done over time. It's really been such a right area, and I think with changes in regulation, for example, there's an area you absolutely want to be active in. Yeah, definitely.
Do you have a favourite for Powder Cap Tech versus Scottish Mortgage?
Oh, that's a tricky one. I mean, they're very different, right? So Scottish Mortgage. I think Scottish Mortgage really gives you a much more broader, diversified exposure. So as I said, you've got Tesla, Amazon, which aren't necessarily part of the pure tech environment. You've got a lot of Chinese exposure. You've got about 20% in China, and that's long term. There's a long term tailwind behind that in terms of it's growing part of the global indices. On the tech side, that's a really that's really an interesting area. Bailey have just opened an office out in Shanghai, I think it is. So they've got boots on the ground, and then you've got the unquoted element. So they're very different. I probably, if I was going to pick one of the two, as you asked me, I'd probably go with Scottish Mortgage with a long term view today. The interesting thing will be to see actually how do some of those unquoted pan out. We've got some short term data. Not everything has worked out perfectly for sure, but there are some interesting underlying investments there.
Okay. This is an interesting question because it sort of touched on what you do. What's your view on funds that are running a kind of manager of managers approach? So things like Lions Trust and Woodham. Do you think that makes sense?
Yeah. So yeah, you're exactly right. There's I suppose S&C is another one, a big one, isn't it? In some ways they're sort of replicating what I and the underlying investment managers are trying to do. So why on earth would you buy those? I think where they have their place might be something like let's say a junior ISA. So if I want broad global exposure and this is the first investment for a child, well, something like a Lions Trust, which we know very well. I used to work with David Shapiro, who's actually just left Alliance Trust, but he was an old colleague. And I think what I would pinpoint Alliance Trust of the various options, just because it's a little bit different under the bonnet. So I think it's 9-10 managers, but rather than buying basically their funds, you're buying their 20 best ideas in the most part. I think emerging markets is a bit broader, and so that's I think that differentiates it. And actually in the States, it's much more, shall we call it, fashionable to invest into a 10 stock portfolios or 20 stock portfolios. much less so here. Maybe in investment trust land a little bit more. But so having those best ideas, I think there's some efficacy to that actually. And there's a lot of research that says if you've got the way to if you ask me, right, tell me what is the secret to investing in terms of what as a new investor, what should I do as a fund manager? And there's a lot of research that says be concentrated, have a low turnover, don't turn over your stocks very regularly, and have one style. And actually, in some ways, it might not matter so much whether it's value or growth. Very long term, this will play out. So I think that's what they're trying to benefit from. So those would be the investors that we would take. But for the most part, we're not buying those fund of funds.
Oh, okay. There are more questions, but I think I'm going to wrap it up there. If that's okay with people.
Yeah.
Just conscious of time. So thank you very much, Nick. And maybe I'll forward on the other questions, and you can maybe choose to ask them by email.
Yeah,
cool. So
I was going to say, we put a few thoughts down on a sort of a pretty short weekly podcast, 7 or 8 minutes. So if anyone's interested, you can sort of have a look on LinkedIn or the Quilter Cheviot website, and you might find it interesting. Equally, you might not.
So that's open to everybody, is it?
Yes, absolutely. Absolutely. You can sign up there. It's called the Fund Buyer on the Quilter Cheviot website, or if you're on LinkedIn, please follow me or sort of connect with me. I'm more than happy to do that. And as I say, hopefully it's not if you're not already bored with my wittering, you might find the odd thing of interest.
Yeah, great. Okay, thanks so much, Nick. Cool.
Brilliant. Thanks for having me on, James. It's been a pleasure.
And so before we go, a few kind of notices. So the property conference is still going. We've just done week 2 where we had Tritax Eurobox and Ground Rents Income Fund, BMO Real Estate, Civitas and UK Commercial Property. And so all the managers of those, we're talking about those funds. You can listen back to that if you could go onto our website and look for the research post that deals with that. And then we've got another one next Wednesday on the 22nd, and we're going to have BMO Commercial Property, Stud Life Investments Property Income, Hibernia REIT, which is an Irish one, which is interesting. Grand Rents Income, no, so not Grand Rents Income, that's the African fund, GRIT. Now that generally is an interesting one. We just probably should note on that. You should probably go and have a look at. And Schroeder European Real Estate, just a bit of a flavour of what's going on in the European markets. And the other thing we're doing on Monday, also accessible through our events area on the website, is a COVID conference. So just talking to a bunch of managers and seeing how COVID's impacted on their funds and what they've been doing about it and what they think the future's like. So that's on Monday, and just go into the event section there and you can sign up for that. Good stuff. So on that note, I will sign out. I'll be back again next Friday. Thank you for listening.